Tile manufacturer Ceramic Industries saw a 30% decline in first half headline earnings per share to 785.3 cents. And joining us in studio now is the company's CEO, Nick Booth. Thanks so much, Nick, for joining us today.
Nice to be here.
Well, we've got building activity in the private and public sectors subdued, exerting pressures, and there's certainly no surprises there. We've been hearing it time and time again. And so weak consumer demand is a big factor that you've had to bear the brunt of here. But an analyst I was chatting to earlier saying that the depressed numbers coming through more so as a result of the pressure you're feeling in Australia relative to South Africa at the moment. Take us through your operating context.
I think the operations in Australia are a contributor. We were fairly profitable in the previous financial year, coming down to a break even for this financial year, which didn't help the numbers, obviously. The reasons in Australia being really internally related in terms of our implementation of new technology, which did not go smoothly and led to loss of market share due to our inability to supply certain products, which we had created an expectation around. We're regaining that market share back slowly, one step at a time. It's taking some work, but we're definitely on the right track there, and I'm quite positive for the coming year in terms of the Australian operation. However, our two SAMCA operations in South Africa also contributed to the decline on much the same scale as Australia. And the challenge there being really that the factories are not as competitive as our Pegasus and Vitra operations in the context of imported product. And hence we lost volumes in terms of sales, and therefore cut back on production volumes to maintain production in line with sales at the two SAMCA operations.
While you try to play that balancing act, it's margins that are coming under pressure here because, I mean, we've had local conditions, things like higher input costs that you haven't been able to, transfer onto your customers via price increases really coming to bear. What impact have you felt on margins specifically?
Oh, big impact on margins. We've had increases on input costs on both gas and our glazes. Electricity has doubled in the last 24 months, so that's been a contributor. And then that combined with the strength of the rand meant that we were in fact had price decreases in terms of maintaining market share. So we're taking margin pressure from both sides.
And then obviously you highlighted as well that underutilization of your factories as well, and that putting added pressure on unit costs. I mean, just how much capacity are you using and what's been left idle?
We, on the tile side, we're running at about 85 to 90% of our capacity, except in Australia where we're running at some 67 to 70% of our capacity. On the sanitary ware side, though, we're running at also between 66 and 70% of our capacity.
Yeah, and obviously a pickup there will be dependent on demand picking up as well. So what's your outlook there? Because things certainly seem murky, especially where we've got a rand that's proving to be so resilient. And as you said, Chinese imports proving to be stiff competition.
The rand, you need a crystal ball and a very clear crystal ball for anybody to get a handle on that. I think what it means for us is that we need to just keep focusing on our internal costs, keeping ourselves competitive. A number of our operations are competitive against the Chinese. It's really going and focusing on those parts of the business that are not competitive enough and keeping the challenge going forward.
Let's take a look at how you're enhancing operational efficiencies, because much of your capital expenditure, and that came in at 130 million rand, was as a result of, or contributed towards equipment upgrades and new technology, and one would assume that that would lend to operational efficiencies eventually.
Correct. I think the challenge we face is being able to produce a good range of products that meets all the market needs. To do that, and with a fixed capacity means you need to do quicker change. To do quicker change, we had to invest in the new technology, which is starting to come through. We're fully operational with the new technology in Australia and our SAMCA wall operation. We're now rolling it out to the other factories.
You're undertaking a feasibility study in the meantime to determine the viability of commissioning yet another plant, and that a tile plant. It'll be dependent, though, I've been reading, on the group's ability to actually acquire mining licenses to secure new clay deposits. How's that looking? Because we know that things have been put on halt when it comes to the Department of Minerals.
I think the moratorium that was placed on prospecting licenses did not help us. We've now put our applications in for prospecting licenses in May, and we're waiting for feedback from the DMR in terms of the go-ahead and acknowledgement of the receipt. Our board is very much of the opinion unless we can guarantee the raw material supplies, we cannot go ahead with investment.
So we can't have any time frames at this stage of the game because it's so dependent on what actually comes out of the Department of Minerals and Resources.
I would agree with that. I think the word you used earlier in terms of the economy was murky, and we feel very much the same way about the DMR at the moment. The picture is murky.
In that context, though, I mean, yes, the group's balance sheet remains strong. Ceramic is a cash-generative business, but run us through the rationale behind the special dividend that you've declared today.
Well, the special dividend was actually declared 2 years ago. 2 months ago, not 2 years ago. We paid a special dividend based on our cash reserves, and the cash really had been earmarked for the new projects. But with the new projects not coming through, it didn't make sense to sit on the cash, and therefore we returned it to shareholders.
Of course, we've got cash reserves still sitting at 217.7 million rand at this stage. Part of your prospects moving forward touch on the fact that you've got the African and European markets offering some growth opportunities, for your products, and that's what you will be exploring your export strategy from here on out. Can you give us some indication as to what we're looking at on the export strategy front?
At the moment, about 20% of our sanitary is exported and some 18% of our tiles. That's a 20% growth on the last financial year, and we're looking to grow that another 30% in the coming year.
Okay, well, Nick, always a pleasure. Thanks so much for joining us in studio today. Of course, Nick Booth is CEO at Ceramic Industries.